If you've spent any amount of time studying the market, you already know that prices never move by accident. They rise and fall according to the timeless rhythm of supply and demand, accumulation and distribution. And that is why today, as we explore these legendary stock market principles that still work, I want you to listen with the same curiosity you had in the previous video on the 3 best ways to invest in stocks for beginners, because everything we discussed there becomes far more powerful once you understand the market's inner workings. Now let me speak plainly. Just as I always have, the market is not a casino, and it is not controlled by luck. It is governed by the intentions of large, informed interests. The composite operator, as I call him. Have you ever wondered why a stock seems to fall the moment you buy it, or rise the moment you sell? It's not personal. It's simply the great operator preparing his campaign while the public reacts emotionally. The trick, then, is to stop trading like the public. Trade like the operator. Read the chart the same way he writes it. When you look at a chart, do you see a bunch of candles and lines, or do you see motives, footprints, and deliberate actions? This is where most traders fail. They think price bars are just data. But each bar reflects a struggle between buyers and sellers. When buying pressure exceeds selling pressure, price rises. When selling pressure overcomes buying pressure, price declines. Simple, yes, but the simplicity is what makes it powerful. Too many chase noisy indicators when the truth sits quietly in the volume and price relationship. The first principle that has stood the test of time is this: no important move begins without accumulation. The composite operator buys slowly, quietly, patiently. Why? Because he wants inventory without raising the price too fast. He wants supply to dry up, and supply dries up only after weak holders finish selling. Have you ever noticed how a dull, sideways market often precedes a strong advance? That dullness is not the absence of activity. It is professional activity hidden from the untrained eye. As traders, we must learn to recognize this preparation phase. Look for tightening ranges, diminished volume on reactions, and firm support levels. These are signs that selling pressure is being absorbed. But absorption takes time, and here is where the trader's mindset must mature. If you're expecting instant gratification, the market will punish you. Patience is not optional. It is a form of capital, just as real as dollars in your account. And this connects directly to something we discussed in that earlier video about beginner-friendly investing strategies. No method, no matter how simple, works well unless you understand what lies beneath price movement. That foundation is what keeps you from chasing tops or panicking at bottoms. The second legendary principle is effort versus result. This is where volume becomes your interpreter. If there is a large amount of effort, big volume, but little result, small price movement, then someone is absorbing supply or supply is overwhelming demand. When you see heavy volume on a rally with little upward progress, ask yourself, who is selling into this demand? And when you see sharp selling pressure met with strong support, ask, who is buying all this stock? Ask these questions out loud. The market speaks clearly if you listen without emotion. Many traders want certainty, but the market doesn't offer certainty. It offers clues. And if you learn to read them, you don't need predictions. You need interpretation. That is why charts are not pictures of the past. They are maps of intention. They show you where the strong hands are active. And trading alongside strength is far safer than trading alongside the crowd. Now let's talk about the law of cause and effect, which I consider one of the most misunderstood yet most valuable concepts in speculation. The market builds a cause, accumulation or distribution, before producing an effect, an uptrend or downtrend. This cause is measurable. The width of the trading range shows you the potential of the upcoming move. Have you ever wondered why a stock sometimes explodes upward after months of inactivity? That explosion is not magic. It is the natural effect of a long, deliberate cause. During these ranges, most traders grow bored. They move on. They want action. But action without preparation is usually a trap. Professionals love impatient traders. They provide the liquidity needed to build campaigns. This is why your mindset must shift from seeking excitement to seeking understanding. Wealth in the market is built not through speed, but through alignment. aligning your trades with the intentions of the strong hands. Some listeners might recall from the previous video how beginners often look for simple entry strategies. But here, in the heart of Wyckoff's principles, we see WHY entries work when they work. A breakout is only reliable when it emerges from a genuine cause. A dip is only buyable when the asset is under accumulation. Without context, entries are just guesses. With context, they become decisions. Another principle that still holds today is following the line of least resistance. The price moves easiest in the direction where opposition is weakest. This is why we always determine the trend first. If the trend is up, you should be thinking like a buyer. If the trend is down, think like a seller. It sounds simple, but how often do traders fight the trend because they feel like the market is due for a reversal? Feeling has no place in market logic. Would you argue with a river's current while swimming? Of course not. So why argue with price? Above all, remember that every trade is a test. Not of the market, but of yourself. Can you remain disciplined when the market tempts you to react? Can you sit with a winning position without grabbing profits too early? Can you accept a small loss without letting your ego demand revenge? These mindset questions matter because wealth in trading is built one sound decision at a time. When we say that accumulation always precedes any meaningful advance, we're not talking about a vague idea or a poetic phrase. We're describing the most fundamental mechanism that drives the stock market's strongest upward movements. Accumulation is the quiet phase, the deliberate phase, the phase where the composite operator and other informed interests prepare the ground for a move long before the public has any idea what's coming. And if you learn to recognize it, you will begin to see the market in a completely different light. You'll stop asking, why is this stock suddenly taking off? And start understanding that the real move began weeks or months earlier, hidden inside those subtle price and volume behaviors that most traders overlook because they seem boring or insignificant. Accumulation is the moment when strong hands scoop up shares from weak hands. But what does that really mean? It means professionals want to own a large position, but they cannot simply rush in and buy in big chunks. They would drive the price upward too quickly and alert others. So they buy in a controlled manner. They buy on down days. They buy when volume dries up. They buy when everyone else is selling because they're scared or bored. Have you noticed how the market tends to look its weakest right before it begins to strengthen? That is not a coincidence. That is the signature of professionals absorbing supply quietly while the public grows discouraged. During accumulation, price often moves sideways in a range. It might seem random, but the range is anything but random. Every reaction is a test. Every rally is a probe. Professionals want to know how much supply remains. How many sellers are still waiting to unload? How quickly does the stock respond after a decline? These clues help them gauge whether the groundwork for the next advance is complete. If you've ever stared at a chart and felt like it wasn't moving fast enough, you were probably watching accumulation happen without realizing it. And if you've ever given up on a stock because it felt stuck, only to see it rally hard after you left, you experienced the downside of not recognizing this phase. The most important thing about accumulation is that it is driven by logic and intention. The composite operator buys with a long-term purpose. He sees value that the public doesn't yet appreciate, and he is patient. He is willing to let time pass so he can gather enough inventory. That patience is something many retail traders struggle with. You might ask yourself, why is nothing happening? Shouldn't the stock move if the fundamentals are good? But the market does not move because of your expectations. It moves when the supply has been absorbed to the point that any new demand pushes price upward with far less resistance. Think about what happens when supply dries up. Imagine a marketplace where there are fewer and fewer sellers. What happens when buyers step in? Prices rise quickly, cleanly, with conviction. That is why a strong uptrend cannot begin until accumulation is complete. It is the drying up of supply that creates the conditions for the next advance. Without that drying up, every rally will be met with selling pressure, pushing price back into the range. This is why you sometimes see a stock try to move up multiple times only to fall back repeatedly. The cause isn't ready yet. The accumulation is not finished. Volume plays a crucial role in identifying this phase. During accumulation, declines often come on lower volume, signaling that selling pressure is fading. Meanwhile, rallies may show slightly increased volume, not explosive, but healthy, suggesting quiet buying. When you see decreasing volume on reactions and slightly increasing volume on upward movements, it's a clue that the professionals are supporting the stock. Have you ever wondered why some charts look like they're coiling, as if pressure is building up underneath? That tightening behavior is exactly what accumulation often produces. The stock becomes more stable, reactions become shallower, volatility contracts. The price is being prepared. Another important aspect of accumulation is the psychological element. The market does not want the public to recognize this phase. Strong hands rely on weak hands to stay fearful or indifferent. If the public saw accumulation clearly, they would hold on to their shares instead of selling them, which would interfere with the professional's ability to buy at good prices. So the accumulation phase usually feels uncomfortable or unexciting to the average trader. It doesn't match the emotional cues that people rely on. This is precisely why the market rewards those who develop the ability to think independently and read the underlying conditions instead of reacting to surface noise. Accumulation also teaches you about timing. You don't need to predict the exact moment a stock will break out. You simply need to recognize when the structure is forming. The timing takes care of itself once the cause is large enough. This principle is why so many traders who chase breakouts fail. They didn't study the cause behind the move. A breakout supported by a proper accumulation base behaves very differently from a breakout that forms out of thin air. The former has power. The latter often collapses. When you train your eye to identify accumulation, you gain something rare in trading: a sense of expectation, grounded in structural logic rather than hope. You begin to understand that the market's strongest moves are not surprises. They are the natural effects of causes built slowly and deliberately beneath the surface. When we say that distribution quietly sets the stage for major declines, we're talking about one of the most revealing yet most misunderstood phases in the entire market cycle. Distribution is the hidden exit door used by the strongest, most informed hands in the market. It's the moment when the composite operator, after accumulating, marking up, and advancing a stock, begins to unload his position. But he does it gradually, carefully, and with precision so that the public doesn't catch on. If accumulation is the quiet inhale before a rally, distribution is the slow, controlled exhale before a decline. And if you've ever wondered why a stock tops out long before bad news arrives, or why declines often begin when everything still looks optimistic, it's because distribution was already happening beneath the surface. Distribution doesn't look dramatic at first. Price may appear strong, even bullish. You'll often see repeated rallies back toward the highs, sometimes even slight breakouts that seem to promise more upside. But these rallies lack the true conviction that comes from genuine demand. When professionals are distributing, they need buyers. And who provides those buyers? The public, retail traders, momentum chasers, people driven by excitement rather than structure. So the market shows strength on the surface to create interest. But underneath that surface, the strong hands are selling into that strength. This is why price action becomes deceptive during distribution. It often appears resilient. It makes traders feel like the trend is still intact. Have you ever seen a chart that keeps pushing upward a little at a time, only to suddenly start falling sharply? That sharp decline didn't come out of nowhere. The groundwork was already laid. The composite operator was selling during those brief rallies, unloading inventory at favorable prices, while the public interpreted every bounce as a continuation signal. This process is why distribution is so dangerous to miss. Because it looks bullish until it's nearly over. One of the key characteristics of distribution is an increase in volatility. Not the type of volatility you see during panics, but a choppiness that wasn't present before. Up days become followed by deceptively strong down days. Volatility widens. Attempts to rally become weaker. Attempts to decline become quicker. This is because supply is quietly increasing. Selling pressure is no longer minimal, it's growing, and the market begins to react differently to the same level of demand. Have you noticed how, near market tops, even good news struggles to lift prices meaningfully? That's because professionals are selling into every bit of optimism. Volume plays a major role here. During distribution, volume often spikes on rallies, which sounds bullish on the surface. But you must interpret volume in the context of price. If price rallies on high volume but fails to make significant upward progress, that's a clue. Heavy effort with little result means someone is absorbing the demand, and who has the capacity to absorb it? Strong hands unloading stock. Meanwhile, when the stock declines lightly on lower volume, it's another clue the selling isn't coming from panic-driven traders yet. It's controlled and strategic. The composite operator is testing how much demand remains in the marketplace. Distribution also tends to form recognizable structures. Wyckoff students often see upthrust after distributions, choppy ranges near the highs, bull traps, and failed breakout attempts. These are the footprints left when the market tries to create the illusion of strength while preparing for weakness. If you've ever felt like a breakout should have worked, but instead failed immediately, you may have been witnessing a distributional trap designed to create the very liquidity needed for professionals to finish selling. Psychology plays an equally crucial role. In accumulation, the public is fearful or disinterested. In distribution, the public is excited. They see past performance and project it forward emotionally. They think, this stock has been going up, it'll keep going up. But professionals don't buy at highs. They sell there. As soon as optimism peaks and late buyers flood in, that's when distribution becomes most active. It's no accident that news headlines are usually most bullish at market tops. It creates the perfect environment for strong hands to offload their shares without spooking the crowd. Another thing most traders don't realize is that distribution takes time. Just as accumulation requires patience, distribution also unfolds over weeks or months. The composite operator cannot dump millions of shares overnight without crashing the market prematurely. He needs to distribute into strength, often creating that strength artificially to maintain favorable prices. This slow distribution creates the sideways, tiring price action that many traders misinterpret as consolidation or rest before the next leg up. But instead of building cause for another advance, the market is building cause for a decline. Understanding this phase changes the way you trade. Instead of blindly buying highs, you start evaluating whether those highs are supported by real demand or merely manufactured enthusiasm. You learn to spot when the market is becoming tired, when rallies are meeting resistance, when volume patterns stop confirming the trend. And once you see distribution for what it is, you start to understand why major declines don't begin with warning bells. They begin quietly, logically, almost invisibly, long before the first sharp drop ever appears on the chart. Recognizing distribution means recognizing when the strong hands are stepping aside, preparing for the next phase of the market cycle, while the unaware public steps in at the worst possible moment, unaware that the environment has shifted from strength to fragility. When we say that volume reveals the truth behind price movements, we're talking about one of the most reliable, time-tested principles in all of market analysis. Price shows you where the market traveled, but volume tells you why it went there and who was behind the move. Without volume, price is just a number on a chart. With volume, price becomes a message. And once you begin reading that message, your relationship with the market changes completely. You stop reacting emotionally to price swings and instead begin interpreting the intentions behind those swings. Have you ever watched a stock rise strongly but felt unsure whether it was real or simply noise? Volume answers that question better than anything else. Volume is the market's energy. It's the effort behind the movement. Think of price as motion and volume as force. When price rises on strong, expanding volume, you know buyers are committed. Professionals are participating. Demand is pushing the stock upward with conviction. But when price rises on weak, diminished volume, that's an entirely different message. It suggests a lack of real buying pressure often hinting at a temporary move that can easily fade. Many traders chase these weak rallies because they look visually appealing, but without volume confirming the move, they're fragile. They fall apart the moment selling pressure reappears. The same relationship works in reverse. When price declines on increasing volume, it indicates that strong selling pressure is active. Supply is overwhelming demand. But when price declines on low volume, the message is different. It suggests a lack of aggressive selling, perhaps just a normal reaction or a test. Many traders panic during low volume pullbacks, thinking something is wrong, but in Wyckoff logic, low volume declines are often the healthiest part of any trend because they show that strong hands are not dumping shares. The market is simply catching its breath. Volume also reveals the presence of the composite operator. He cannot hide his tracks entirely. His buying and selling leave footprints in the volume, even if price doesn't always respond immediately. Have you ever seen a day where the volume surged but the price barely moved? To the untrained eye, that might seem meaningless, but it's actually one of the most important clues you can spot. High volume with little progression tells you that someone is absorbing the effort. If it happens on an up day, large sellers may be present. If it happens on a down day, strong hands may be absorbing supply. This is how you know when a stock is under accumulation or distribution long before the trend becomes obvious. Another powerful insight volume offers comes from comparing effort versus result. In trading, effort refers to volume, and result refers to price movement. When the effort is large but the result is small, something is out of balance. It means there is strong opposition, and opposition means activity from informed interests. This imbalance is often the first signal that a trend is weakening or strengthening even before the chart visibly changes direction. Many traders wait for breakouts or breakdowns to confirm shifts, but by the time the shift is visible, the professionals have already acted. Volume warns you earlier, sometimes much earlier. Volume also tells you when a move is genuine rather than manipulated. A sharp rally on low volume is often a trap. It's designed to lure in inexperienced buyers while strong hands prepare to sell into the emotional wave. On the other hand, a rally supported by consistent, growing volume suggests the beginning of something real, something sponsored by large interests who intend to push the stock higher. The public usually sees only the price. The professional sees the behavior behind it. When you look at volume in relation to price bars, you start noticing subtle shifts. During accumulation, down bars tend to lose volume. Selling pressure weakens. During distribution, up bars often appear with heavy volume but limited spread. Buying pressure isn't real. It's being met by hidden selling. These differences may seem small at first, but they are the difference between buying at the beginning of a move versus buying at the peak of excitement. Another area where volume proves its value is during breakouts. A breakout without volume is more likely to fail than succeed. It may poke above a resistance level, but without real demand behind it, the move lacks endurance. Conversely, a breakout with strong, expanding volume usually indicates that professionals have stepped in and are ready to drive the next leg of the trend. This is why many traders get trapped in false breakouts. They look only at the price barrier being crossed, not the conviction behind it. Volume also helps you distinguish healthy corrections from dangerous ones. A correction on light volume is often a natural pause. But when volume spikes on a decline, especially near market tops, it tells you that distribution is underway. Supply is hitting the market aggressively. If you've ever been caught holding a stock that suddenly collapses, you've experienced what it feels like to miss the early volume warnings. Even in the later phases of trends, when emotions run high, volume continues to guide you. At the climax of a bull run, you'll often see massive volume surges as the public rushes in. That enthusiasm exhausts the remaining demand, leaving the stock vulnerable. At the end of a panic, in a selling climax, volume spikes again. But this time it represents capitulation and the transfer of shares back into strong hands. Volume is the language of these transitions. It tells you when fear is peaking, when greed is peaking, and when the professionals have stepped in or stepped aside. If you train yourself to read volume as carefully as you read price, you start to see the market differently. You no longer get fooled by surface-level movement. You gain the ability to interpret the underlying intentions that drive price. And once you reach that point, the market stops feeling chaotic and becomes far more structured, far more logical, far more understandable than it initially appears. When we talk about the composite operator guiding trends through deliberate campaigns, we're talking about one of the most powerful ideas that can change the way you look at markets forever. Most traders imagine the market as a chaotic place where millions of individual decisions collide randomly. But when you understand the concept of the composite operator, this idea that a group of large, informed interests behave collectively as if they were one unified entity, you begin to see order where others see noise. You begin to recognize that the market's major moves are not accidents. They are carefully constructed campaigns carried out with patience, planning, and intent. And if you can learn to follow that intent, rather than fight it, you put yourself in a position to trade alongside the strongest hands in the market. The composite operator, sometimes called the smart money, does not chase prices, react emotionally, or make decisions based on short-term excitement. He operates strategically, almost methodically. His goal is to accumulate shares when the crowd is uninterested, mark the stock up when conditions are ready, distribute it when the crowd is euphoric, and then allow the markdown to unfold naturally. This cycle repeats over and over because human behavior repeats over and over. Have you ever wondered why market patterns from 100 years ago still appear on charts today? It's because the underlying psychology hasn't changed, and the way the composite operator takes advantage of that psychology hasn't changed either. To understand his campaigns, you must understand his motives. The composite operator wants to buy low and sell high, but he wants to do so quietly. He doesn't want the public to notice what he's doing. During accumulation, he buys slowly to avoid driving up the price. During distribution, he sells gradually to avoid collapsing the price prematurely. These deliberate actions create the very chart patterns Wyckoff spent his life studying. Trading ranges, springs, upthrusts, breakouts, tests. These are not random formations. They are the footprints of the composite operator as he builds or unloads his position. Think about how a professional must operate. He cannot simply place huge orders at once, because that would expose his hand. Instead, he needs reactions, swings, and moments of weakness from the public to provide him with liquidity. If he wants to accumulate, he needs people who are willing to sell. If he wants to distribute, he needs buyers chasing into strength. This is why so many strong uptrends begin after long, slow, boring accumulation phases. And it's why so many devastating downtrends begin after thrilling, optimistic peaks where everyone wants to buy at the worst possible moment. Now consider how the composite operator manipulates perception, not illegally but strategically, through the natural ebb and flow of price action. During accumulation, he may allow the price to fall just enough to shake out emotional traders. He may support the stock at key levels to create a stable base. During distribution, he may push prices just above resistance to trigger breakout buying, giving him the perfect exit liquidity. If you've ever entered a breakout that failed instantly, you've likely stepped directly into one of these distributional traps. The idea that one unified operator guides trends isn't meant to imply there's a single person controlling the market. It's a conceptual tool that helps you read the collective actions of institutions, funds, and large operators whose behavior is consistent enough to appear as a single force. These participants think in campaigns, not in day trades. They plan months ahead. They study supply and demand. They accumulate when the public is fearful. They distribute when the public is confident. And because their size is so large, their actions shape the very structure of price movement. Volume confirms where the composite operator is active, but price shows you his strategy. Notice how a stock behaves around support. Notice how it reacts to resistance. Notice how rallies accelerate or stall. These are the clues that reveal whether the composite operator is absorbing supply, supporting price, unloading inventory, or simply observing. Many traders think the market is unpredictable because they're watching every tiny fluctuation. But once you zoom out and look at the broader structure, you start seeing intent. You begin to think less about what the market might do and more about what the composite operator is trying to accomplish. Another key point about his campaigns is that they require time. The public wants fast results. The composite operator wants correct results. His accumulation may take months. His markup happens only when conditions are ready. His distribution may be disguised inside rallies that appear strong on the surface, but are hollow underneath. And his markdown continues until weak holders have finally capitulated and the cycle can begin again. When you learn to see the market through this lens, you're no longer surprised by fake breakouts, sudden reversals, or slow grinding trends. You understand that all of these movements serve a purpose within the operator's campaign. You learn to anticipate the phases rather than react to them. And instead of trying to outguess the market, you begin aligning yourself with the forces that truly move it.